Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last two videos I have completed 8 problems on CVP analysis. In this video, 9th, 10th, 11th, 3 more problems I'm going to explain. See here, this CVP analysis problems, we have different nature of problems. We can't say which type of problems may appear in examination. So you have to be perfect on all the problems. So my suggestion, if you want the perfect knowledge, in-depth knowledge, watch all the videos till the end. Not once, twice, thrice. Then only you can be able to get the complete grasp on the topic of CVP analysis. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel. Select the subject Accounting for Management. Select the videos of CVP analysis. Be perfect on the formulas. And then only you can understand the coming problems. Now, in this problem, I'm going to start with 9th. But before that, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. And take the screenshot of this 9th, 10th and 11th problem. Then I'll explain all the points in detail. See the 9th problem. Manali Corporation Limited has prepared the budget estimates for the year 2017-18. Sales in units are 15,000. Sales in units are 15,000. Then fixed expenses 34,000 rupees. Sales value 1,50,000. Variable cost rupees 6 per unit. Here total sales value is given 1,50,000 and number of units are given 15,000. So we can calculate selling price per unit. Then you are required to find out PV ratio, BP and MOS. Very easily we can find out all the three. In the previous problems we have applied the formula. The only thing you have to remember the formula. So while giving my lecture, take a notebook, calculator, pens, etc. beside you. And whatever I am explaining, write it down, particularly formulas. Because the complete problems of CVP analysis are based on formulas. So first question, calculate PV ratio, BP and MOS. Second question, calculate the revised PV ratio, BP and MOS in each of the following cases. First case, decrease of 10% in selling price. Second, increase of 10% in variable cost. One by one, we will attempt. First of all, selling price per unit is not given. We calculate selling price per unit. Here, SP per unit, selling price per unit is equal to sales value divided by sales in units. So it is given 1,50,000 rupees is the total sales value and 15,000 units are the number of units sold. So 1,50,000 by 15,000, 10 rupees per unit is the selling price. And variable cost per unit 6 rupees directly given in the problem. Now we can find out PV ratio, profit volume ratio. C by S into 100. In place of C we can write S minus V or F plus P. But here we are having selling price, we are having variable cost. Remember PV ratio can be calculated either by taking per unit or total. Total sales minus total variable cost divided by total sales. You will get the same answer. Or selling price per unit minus variable cost per unit divided by selling price per unit. You will get the same answer. So here S minus V by S, 10 rupees selling price, 6 rupees variable cost. So 10 minus 6 by 10 into 100, 4 by 10, 40%. So one item we got PV ratio, we got 40%, 0.4. Now BP, break-even point first we calculate in units. The formula is fixed cost divided by SP per unit minus VC per unit. Selling price per unit minus variable cost per unit. The fixed cost is given in the problem itself, 34,000. It is given. Divided by selling price, 10 rupees, variable cost 6 rupees. So 10 minus 6, 4. So 8,500 units is the break-even point. Now we can easily calculate BP in rupees also. Whatever BP in units you got, multiply by selling price. So BP in rupees is equal to BP in units into selling price per unit. So 8,500 units is the BP multiply by selling price 10 rupees. So 8,500 into 10, 85,000 rupees is the BP. Last one, MOS, margin of safety. Actual sales minus BP sales. Actual sales given in the problem 1,50,000 and break-even sales 85,000, just now we have calculated. So 150 minus 85, you will get 65,000 is the margin of safety. First part we have completed. The second part, it is saying what is the change in PV ratio, BP and MOS in two situations. What are the two situations? First, selling price decreased by 10%. Suppose if the selling price is decreased by 10%, what would be the change in PV ratio, BP and MOS? So when selling price is decreased by 10%, so 10 minus 10%, 10% of 10 is 1. So 10 minus 1, 9. The new selling price is 9 rupees. Now PV ratio, C by S, S minus V by S, 9 minus 6 by 9 into 100. You will get 33.33%. So earlier it was 40%. Now PV ratio has decreased to 33.33%. Why? Because selling price is reduced by 10%. Now new BP. Fixed cost divided by new PV ratio. The fixed cost remaining same, 34,000. The new PV ratio is 0.33. 33.33 means 33.33 divided by 100. You will get 0.33333 like that. So finally, 1,02,000 is the new BP. New MOS, margin of safety. So actual sales minus new BP. Actual sales are 1,50,000. Now new break-even point we got 1,02,000. So 48,000 is the MOS. The beginning we have MOS how much? 65,000. Now MOS has decreased to 48,000. Why? Because selling price is decreased by 10%. The next is variable cost increased by 10%. Previously, originally variable cost was 6 rupees. Now there is increase by 10%. Is it increase or decrease? Ninth problem, it is increased by 10%. So new variable cost per unit, it is increased by 10%. 6 plus 10%. So 6 plus 0.6, you will get 6.06 or 6.6, sorry. 6 rupees plus 10%. 10% of 6 rupees is 0.6. So 6 plus 0.6 is 6.6. So new PV ratio, S minus V. So here 10 minus, here I have committed a mistake, that is 6.6. This is not 46%. Again I'll calculate. Small mistake. 10 minus 6.6 divided by 10 into 100. You will get 34%. Here it is 34% is the new PV ratio. Now new break-even point, fixed cost divided by PV ratio. So fixed cost 34,000, PV ratio is 0.34. So this will change. 34,000 divided by 0.34 divided by 0.34 is equal to 1 lakh, exact 1 lakh. This is the new break-even point. Now new margin of safety is actual sales 1,50,000. Break-even sales, it is 1 lakh. So 1,50,000 minus 1 lakh, you will get 50,000. Small mistake was there. Actually, it is increased. So I should have taken plus, but I have taken by mistake minus. So that's why now it is absolutely right. The new MOS is 50,000. That's all. 9th problem completed. Now, 10th one. Sales are 2 lakh, profit 20% to 20,000. Variable cost is 60%. You are required to calculate PV ratio, fixed cost, sales volume to earn a profit of 50,000. Now, first of all, sales are given 2 lakh. Profit is given 20,000. And variable cost, it is given 60% of sales. Sales are how much? 2 lakh. So, 60% of 2 lakh, you will get 1,20,000. So, we have sales, profit and variable cost. First, it is asking you to calculate PV ratio. C by S into 100. In place of C, I am writing S minus V because I have sales, I have variable cost. S minus V by S into 100. So 2 lakh minus 1,20,000 divided by 2 lakh into 100. 40%. So first answer we got PV ratio 40%. Secondly, it is asking you to calculate fixed cost. For finding out the fixed cost, we use the PV ratio. The PV ratio formula C by S. Now in place of C, I am writing F plus P. I am not taking S minus V. We can take S minus V or we can take F plus P. But we need fixed cost. That's why I am taking F plus P by S. So PV ratio already we got 40%. 40% means 0.4. So 0.4 is equal to F. Fixed cost we don't have. But profit is given 20,000. So in place of profit 20,000, sales are given 2 lakh. Make a cross multiplication. F plus 20,000 into 1 is F plus 20,000. 0.4 into 2 lakh is 80,000. Bring this 20,000 to RHS. So plus 20 will become minus 20. So fixed cost we got 60,000. Second question completed. What is the third question? Sales volume to earn a profit of 50,000. How much would be the sales to earn a desired profit of 50,000? The formula is fixed cost plus desired profit divided by PV ratio. The fixed cost 60,000, we got it here. And desired profit 50,000 given in the problem. PV ratio is 0.4. So 1,10,000 divided by 0.4, you will get 2,75,000. So by making a sale of 2,75,000, we'll get a profit of 50,000. That's all. This is the end of problem number 10. Now 11th problem. See carefully. There are two similar plants under the same management. 11th problem. Two plants they are having under the same management. One company is there, they are having two plants, plant 1, plant 2. The management desires to merge these two plants. The management wants to combine. Instead of operating separately, the company wants to merge both the plants and run as a unit. So plant 1, plant 2. Plant 1, capacity operation 100%, whereas plant 2, capacity operation is only 60%. Sales are given for plant 1 300 lakhs, for plant 2 120 lakhs. Variable cost plant 1 220 lakhs and plant 2 90 lakhs. And fixed cost 40 lakh, 20 lakh. This is the information given separately for plant 1 and plant 2. The question is, you are required to calculate what would be the capacity of the merged plant to be operated for break-even. That means at what percentage capacity the merged plant will operate at break-even, BB. And secondly, what is the profitability on working at 75% of the merged capacity? So two questions are asked. One by one, we'll try to attempt. Now see carefully. Again, a different problem, entirely different. Two plants, plant 1, plant 2. The company want to merge them and find out what is the percentage capacity of the merged plant. Now see here, particulars. Now these are the columns I need. What are the columns? Plant 1 at 100%. So whatever is given in the problem, same thing I am taking down. Plant 1 at 100%. Second column, plant 2 at 60%. In the problem it is given the plant 2 operating at 60% and the data is given at 60%. But we don't require 60%. We want both the plants at 100% capacity. At 100%. So we have to convert plant to 60% to 100%. So I am opening plant to 60%, plant to 100%. Then merged plant. Merged means combined. So here I am combining plant 100% and plant 200%. So the 60% I am not combining. I am combining only plant 100%, plant 200%. Don't take this 60%. Because simply to convert that 60% to 100%, I am taking this column. Otherwise, this column will not be required. Now, sales. In the problem, sales are given. Plant 1, 100% capacity, sales are 300. It is given in the problem. Whereas plant 2, sales are given as 120 lakhs at 60% capacity. But we don't require 60%, we want 100%. How much would be the sales of plant 2 at 100% capacity? Here, calculations are here. At 60% capacity, the sales are 120 lakh. You can see here, Plant 2 60% capacity 120 lakh. But I want to convert it into 100%. So for 60% 120 lakh, 100% how much? So 100 by 60 into 120, you will get 200 lakhs. So plant 2 100% capacity, the sales would be 200 lakhs. I have converted 60% to 100%. Now merged plant, combined. So 100% plant 1, 100% plant 2. So 300 plus 200, 500 lakh is the total sales of the merged plant, combined plant, minus variable cost. Plant 1, variable cost at 100% is given 220 lakhs, no change. Plant 2, at 60% capacity, the variable cost is 90 lakh. But we don't require 60%, we want 100%. So here are the calculation. At 60% capacity, the variable cost is 90 lakh. At 100% capacity, how much? So 100 by 60 into 90, you will get 150 lakh. So 150 lakh is the variable cost at 100% capacity. Merged plant, combined. Plant 100%, 220. Plant 200%, 150. So 220 plus 150, 370 lakh is the variable cost of the merged plant. Sales minus variable cost, what we get? Contribution. Subtract. 300 minus 220, 80. 120 minus 90, 30. 200 minus 150, 50. 500 minus 370 is 130. You can cross verify. 80 plus 50 is 130. Calculations are right. Minus fixed cost, less fixed cost. The fixed cost for plant 1 at 100% capacity 40 lakh. The fixed cost for plant 2 at 60% capacity is 20 lakh. But remember, the fixed cost will remain same whether the plant is operating at 60% or 100%. The fixed cost will remain constant. You should not change the fixed cost. Variable cost will change, but fixed cost will remain constant. So same 20 lakh I am taking here fixed cost. So 40 plus 20, 60 lakh is the total fixed cost of the merged plant. Now deduct fixed cost. 80 minus 40, 40 is the profit. 30 minus 20, 10 profit. 50 minus 20, 30 is the profit. 130 minus 60, 70 is the profit. So we got the profit. Now PV ratio. The formula for PV ratio, contribution by sales into 100, C by S into 100. Contribution, how much we have? 80. So 80 by 300 into 100, you will get 26.67%. This is the PV ratio for plant 1. Plant 2, contribution is 30. 30 by 120 into 100, 25% is the PV ratio for plant 2 at 60%. At 100%, contribution is 50. 50 divided by 200 into 100, 25%. Last one, merged plant. The merged plant contribution is 130. So 130 by 500 into 100, 26% is the PV ratio of the merged plant. So we have calculated PV ratio. Now easily we can find out the BEP, break-even point. The formula is fixed cost by PV ratio. Everything we have. The fixed cost, 40 lakh. PV ratio, 26.67. So 40 divided by 0.2666, you will get 150 lakh. So 150 lakh is the break-even point for plant 1. Similarly for plant 2 at 60%. Fixed cost 20. 20 divided by 0.25. 80 lakh is the BEP for the second plant at 60%. At 100% also you will get the same thing. Because fixed cost is 20 lakh, PV ratio is 0.25, 80 lakh. Lastly, what is the BEP of the merged plant? Merged plant fixed cost 60 lakh and PV ratio 26%. So 60 divided by 0.26, you will get 230.77 lakhs. This is the BEP of the merged plant. Calculative part completed. Now we attempt to the problem. The first question it is asking you, what is the capacity of the merged plant to be operated for break-even? When both the plants are merged together, at what percentage capacity the BEP is attained for the merged plant? So the formula is sales at break-even of the merged plant divided by total sales of the merged plant into 100. So at what level of sales BP is attained? 230.77 lakhs. And what is the total sales of the merged plant? 500 lakh. So here 230.77 divided by 500 into 100, 46.15%. This is the capacity of the merged plant to be operated for break-even. When the company attains 46%, the company will be at BEP, merged plant. Secondly, profitability on working at 75% of the merged capacity. If the company is operating at 75%, see here, at 46% of the capacity, no profit, no loss, BEP. 46%, no profit, no loss. Whereas we want to find out what is the profitability at 75%. Definitely there is a profit. Now how much is the profit? Sales. 75% operating. At 100%, what is the total sales of the merged plant? 500 lakh. 500 lakh is the 100% sales, but we need 75%. So 75% of 500, it comes to 375 lakh minus variable cost. Variable cost will also be taken 75% of total variable cost. What is the total variable cost here? 370 lakhs. So 75% of 370, you will get 277.5 lakh. So we got sales, we got variable cost. So sales minus variable cost, we get contribution. 97.5 lakh is the contribution. Minus fixed cost. Remember, fixed cost will remain same whether we operate at 75% or 100%. Right? So what is the total fixed cost here? 60 lakh. 60 lakh is the total fixed cost of the merged plant. So deduct 60 lakh, you will get 37.5. 37.5 lakh. This is the profit at 75% of the merged capacity. Now rate of profit. Simply if you calculate profit, that is over. But if we want to find out the rate of profit on sales, the rate of profit on sales is equal to profit by sales into 100. What is the profit? 37.5 lakh. What is the sales? 375 lakh. So 37.5 divided by 375 into 100. 10%. That means the profit is 10% of sales if the company is operating at 75% capacity. That's all. So I have completed 3 problems in this video, that is 9th, 10th and 11th. So if you are satisfied, give a like to the video, share my channel, subscribe if you have not yet subscribed, and buy the super thanks which is given in the below the video. Inshallah, I'll continue the next problem in the next video.